Ever wondered what M1, M2 and M3 money supply mean and how they relate to each other? Well, you're in for a treat today as we unravel the mystery behind these economic jargons. In the world of finance and economics, the term money supply is far from foreign. It's essentially the total value of money available in an economy at a particular point in time. But here's where things get a bit more complex. This money is not just the cash in your wallet or the coins jingling in your pocket. It extends beyond that, encompassing various forms of credit, cash, checks and money market securities. Now, let's talk about M1, M2 and M3. No, we're not discussing some secret agents from a spy thriller. These are measures of the money supply, each one including different types of money based on their liquidity. That is, how quickly they can be used for spending. M1 is the most liquid form of money. It includes cash and assets that can be quickly converted into cash, like checking accounts. M2 is a tad broader. It includes all of M1 plus some additional assets that aren't quite as liquid, like savings accounts. And then there's M3, the broadest measure of all. It includes everything in M2 plus large deposits, institutional money market funds, and other larger liquid assets. But why do we need these measures? Well, they are not just random letters and numbers. They are crucial to understanding the health of an economy. They help central banks, like the Federal Reserve in the United States, to formulate monetary policy and control inflation. So, the next time you hear someone drop the terms M1, M2 or M3 in a conversation, don't be puzzled. They're simply talking about the different measures of money supply, each with its own significance in the economic sphere. Now that we have the basics down, it's time to delve deeper. Let's dive into the world of money supply and uncover the mystery behind M1, M2 and M3. Imagine you're at a bustling market ready to buy the freshest produce with the cash in your wallet. That cash, my friends, is what we call M1. M1 is the most liquid form of money we use daily. It's the physical currency, coins and notes, that we hold in our wallets, ready to be spent at a moment's notice. But M1 isn't just the physical cash in our hands. In the modern age, it also includes checking accounts, which are as good as cash for most transactions. You can write a check or use a debit card connected to your checking account to make immediate payments without the need for conversion or time delay. Imagine again the bustling market. You're holding a basket of fresh produce ready to pay. You could pull out a £10 note from your wallet, that's M1. Or you could whip out your debit card and pay straight from your checking account. Again, that's M1. The convenience and immediacy of these transactions is what makes M1 the most liquid form of money. Now let's delve a little deeper. The concept of liquidity is central to M1. In finance, liquidity refers to how quickly an asset can be converted into cash without losing its value. The more liquid an asset, the quicker you can use it for transactions. And nothing is more liquid than cash itself or the money in your checking account. They can be readily exchanged for goods or services without any loss of value or time delay. So, we could say that M1 represents the cash economy. It's the money that circulates in the economy, making immediate transactions possible. It's the lifeblood of daily trade, from buying a cup of coffee to paying for a taxi ride. But M1 is just the tip of the iceberg when it comes to money supply. Yes, it's the most liquid form, but it only represents the money we can spend immediately. There's more to the money supply than just M1, and that includes the money we can't spend right away. So, M1 is the money you can spend immediately, but what about the money you can't? Let's move on to M2. Picture yourself wanting to buy a house. You can't use the cash in your wallet, can you? You need to dip into your savings. This is where M2 comes into play. M2 is a measure of the money supply that includes all elements of M1, which is the most liquid form of money, as well as some slightly less liquid forms of money. Now, when we say liquid, we're talking about how quickly and easily an asset can be converted into cash. For instance, M2 includes things like short-term time deposits in banks. These time deposits are essentially savings accounts or certificates of deposit that you can't just withdraw from without a penalty. They're not as liquid as the cash in your wallet or your checking account, but they're still relatively easy to convert into spendable money if you need to. M2 also includes money in 24-hour money market funds. These funds are like savings accounts that offer a higher interest rate, but they come with a catch. Usually you need to maintain a higher minimum balance, and you may not be able to withdraw money as easily as you would from a regular savings account. So let's go back to that house you want to buy. You can't just pull out a wad of cash or write a check from your checking account, right? You'll likely need to dip into your savings, maybe break a CD before it matures, or pull some money out of a money market fund. All these assets are part of your M2 money supply. M2 is a broader measure of the money supply because it covers not just the money that's readily available for spending, but also money that's a bit less liquid but still accessible. It gives us a more complete picture of the economy's money supply, helping us understand the full range of resources individuals and businesses have at their disposal. M2 gives us a broader view of money, but there's still one more level to uncover. Let's journey into the realm of M3. Ever invested in long-term assets like bonds or large time deposits? Welcome to the world of M3. As we delve deeper into the money supply, we find ourselves in the realm of M3. M3 is the broadest measure of money supply, encompassing M2 and adding even more types of financial assets. What exactly does M3 include? Well, in addition to everything covered by M2, it also includes longer-term time deposits and institutional money market funds. These are the types of assets that aren't as easily converted into cash but are still considered part of the money supply. Just imagine, if you will, that you've invested in a long-term bond. This bond isn't something you can just walk into a store and use to buy a cup of coffee. It's not exactly liquid, is it? But it's still a financial asset. It's still money. It's just tied up in an investment. This is the kind of asset that falls into the M3 category. Institutional money market funds, on the other hand, are investment vehicles that pool together funds from various investors. These funds invest in short-term, high-quality instruments like treasury bills. While these funds offer high liquidity, they are not as liquid as the assets included in M1 or M2, hence their inclusion in M3. Now, why is M3 important? M3 provides a broader picture of the economy's health by taking into account more types of financial assets. Economists and policymakers use M3 to get a comprehensive understanding of the money supply and to make informed decisions about monetary policy. But remember, the more we move away from M1, the less liquid the forms of money become. M3 thus represents the least liquid form of money. It's a bit like a cake, really. M1 is the sponge, easily digestible. M2 adds the frosting, a bit more substantial, and M3 is the cherry on top, the smallest part, but still a vital piece of the whole. Now that we've traversed through M1, M2 and M3, it's time to wrap up our journey. But don't worry, we'll continue to explore the fascinating world of finance in our upcoming videos. Stay tuned. So, we've journeyed through the markets of M1, the banks of M2, and the investment firms of M3. But how do they all fit together? Well, let's recap. M1, the most liquid form of money, includes cash and other assets that can be quickly converted into cash. Think of it as the money in your wallet or your checking account. M2, a step further, includes all of M1 and adds short-term time deposits, savings accounts, and non-institutional money market funds. It's a broader definition of money and a little less liquid than M1. And lastly, M3 is the broadest measure of money. It includes M2 and large time deposits, institutional money market funds, short-term repurchase agreements, and other larger liquid assets. It's the money that's not as easily accessible, but still plays a vital role in our economy. These three measures, M1, M2, and M3, give us a comprehensive picture of an economy's liquidity and economic stability. They show us the availability of money and how it's distributed in the economy. They help economists and policymakers understand the health of the economy, determine the effectiveness of monetary policy, and predict future economic trends. But these aren't standalone entities. They're interconnected. M1 is part of M2, and M2 is part of M3. Each one builds on the other, adding layers of depth to our understanding of money supply. They're like a set of Russian dolls, each one nesting inside the other, each one revealing a little more about the money in our economy. Understanding M1, M2, and M3 isn't just about knowing economic jargon. It's about understanding the lifeblood of our economy, money. So, next time you reach for your wallet, remember the journey of M1, M2, and M3. It's not just about cash, checks, or savings accounts. It's about the flow of money, the pulse of the economy, and the intricate dance of liquidity and stability.